Tax season always feels like it's sneaking up on us, doesn't it? And every single year, the big question is, how can I actually save some money? Well, today we're going to dive deep into the single most important tax-saving tool you absolutely need to get a handle on.
I mean, let's be honest. Trying to figure out all the tax laws can be, well, it's just overwhelming. But what if I told you there was one big lever, just one, that you could pull to make a huge difference? You're in luck, because that's exactly what we're going to do. We're cutting through all that noise to show you precisely what that is. Okay, here it is. This right here. This is the magic number, 1,50,000 rupees. You're going to want to burn that number into your brain. This is the absolute maximum amount you can slice off your taxable income, all thanks to one super powerful section in the Income Tax Act. Nailing this is step one to saving big. And the key that unlocks that massive deduction? It's called Section 80C of the Income Tax Act. Now, this isn't just for individuals. It also works for Hindu undivided families, or HUFs. It basically lets you claim a deduction for up to 1.5 lakh rupees just by putting your money into certain approved investments and expenses. All right, so the big question is, how do you actually claim this money? Well, it's not just one thing you have to do. Think of it more like a basket of options you can choose from. Let's kick things off with the deductions that are all about building a rock-solid financial future for yourself. First up is a real classic, something many of you probably already have, your life insurance premium. Yep, any money you pay for a life insurance policy, whether it's for you, your spouse, or your children, it all counts towards this deduction. And if you're part of a Hindu undivided family, it's even better. It can cover any member of the family. It's just a fantastic tool for both protection and tax saving. Okay, next on the list, provident funds. Now, this one is a huge deal for a lot of folks. If you're a salaried employee, your contribution to your employee's provident fund, or EPF, totally qualifies. But hey, even if you don't have an EPF, don't worry. You can still get in on this by contributing to a public provident fund, the PPF, which is a government savings plan that's pretty much open to everyone.
So let's just break that down one more time. The key thing to remember is this. EPF is tied to your job. PPF is something you open up yourself, completely voluntarily. But here's the best part. Both of them are incredible tools for building up your retirement savings, and they give you that awesome, immediate tax break under Section 80C.
Moving on, let's talk about deductions that are really all about investing in your family and your loved ones. What's so great about these is they take expenses you're probably already making and turn them into fantastic ways to save on tax. Parents, listen up, because this one is for you. It's an absolutely brilliant deduction. You can actually claim the tuition fees you pay for up to 2 of your kids' full-time education. And it doesn't matter where, any school, college, or university right here in India, from kindergarten all the way to a PhD.
Okay, but, and this is a big but, here's the fine print you have to know. The deduction is strictly for the tuition fee itself. It does not cover things like development fees, donations, or any of those other random charges. This is where a lot of people get tripped up, so please double check those fee receipts.
Buying a home is such a huge milestone for so many of us, and thankfully, the government gives you a little help with tax breaks. So that principal amount you repay on your home loan every month, that's eligible for a deduction under 80C. This also includes payments for things like self-financing housing schemes. It's really a win-win. You build a massive asset, and you save tax along the way. All right, for our last category, let's talk about some really smart investment deductions. These are the options that let you do 2 things at once, save on tax and actually make your money work harder for you. Now, a super popular and really straightforward option is the tax-saving fixed deposit, or FD. There's one main rule. It's got to be locked in for a minimum of 5 years. You can open one up with pretty much any scheduled bank, or you could go for the 5-year post office time deposit. That counts too. It's just a very safe, very predictable way to reach your tax-saving goal. And believe me, the list does not stop there. Section 80C is actually pretty huge. You've also got things like the Senior Citizen Savings Scheme, ELSS mutual funds, if you're comfortable with the stock market, and even ULIPs, which are a mix of insurance and investment. It just goes to show you how much flexibility you really have to find something that fits your personal style and your financial plan. Whew, okay, we've gone through a ton of information. So now the question is, how do you mix and match all of these to get to that magic number, 1,50,000? Let's put all the pieces together and do a quick recap. This little table really breaks it all down nice and simple. You can clearly see how each of the big 5 deductions we talked about connects to a specific financial goal. You've got family protection, retirement savings, your kids' education, creating an asset, and just secure savings. And remember, the best part is you don't have to choose just one. You can and should mix and match these to build up to that full 1,50,000 limit. Even Albert Einstein said that the hardest thing in the world to understand is income tax. So if you find it confusing, you're in good company. But here's the thing. By just getting a handle on these 5 key pillars of Section 80C, you've made the toughest part of saving tax so much simpler. It really is all about just knowing what your options are.
So, that leaves us with one final question, and this one's for you to think about. Now that you know what's on the table, which of these deductions really fits into your financial plan for this year? Are you focused on retirement, buying a house, your kids' future? Which of these tools are you going to use to build your very own 1 lakh 50,000 rupee tax saving strategy?